Hello, friends. How are you? So, today we are meeting again to revise two very simple topics. One is penalties, and second is tax audit. So, we don't call it penalties, we call it provision to counteract unethical tax practices. So, if any assessee does not comply with the provisions of the act, does not do his duties, then there are some contract provisions which deter him to to perform within the provisions of the act. So without wasting much time, let's start. Okay. So there are a lot of penalties under the act which we will discuss today. Firstly, if a default has occurred, then the law of which year is applicable in case of penalties. So what the provision says, they say that the penalty is levied on assessee. The penalty to be levied on assessee is based upon the law as it stood at the time of default. So law which is there at the time of default is applicable and not the law as it stands in the financial year for which the assessment is made. So when the default was made, the law at that time was to be applicable on the assessee. Okay. Penalty. Now, the most common and most important penalty is penalty for underreporting of income under section 270 capital A. Okay. So if you guys know, earlier there was a penalty under section 271(1)(c). However, with effect from AY 1718, such provision was deleted and a new provision section 270 capital A was introduced. Now, under section 270 capital A, who is authorized to levy the penalty? So section 270 capital subsection 1 says that any assessing officer, joint commissioner appeals or commissioner appeals or principal commissioner or commissioner. These officers are authorized to levy penalty under section 270 capital A. Why are these officers authorized? Because if you see, all these officers have a right to enhance the income of assessee. And the officer who actually made the addition is the person who levies the penalty. So assessing officer made the addition, the assessment. JCIT appeal and the CIT appeal has a power to enhance in case of appeal. And the principal commissioner and commissioner has a power under section 263 to revise. Okay. Now, what do we mean by underreported of income? So the law says if A is more than B, then there is underreporting. So long as A, what we will see in a minute, what is there in A. If A is more than B, then there is underreporting. Okay. Now there are different cases. Their cases are divided into two parts, where the income is assessed and where the assessment is made on the basis of book profit under MAT or AMT as the case may be. Okay. So first, where the assessment made on the basis of normal provisions and the assessee had filed the return. Then the A is the income assessed and B is the income as per section 143(1) at the time of processing of the return. Next case is if assessee has not filed any return of income. Then if the income assessed exceeds the basic assumption limit, then there is underreporting. And thirdly, if there is a reassessment, then if the income reassessed is more than the income earlier assessed, then there is underreported income. Then if the income is return of income was filed and the assessment is made on the basis of book profit under MAT or AMT, then the book profit so assessed if such book profit are more than the book profit as per the intimation of section 143(1). Okay. When no return of income is filed and the assessment is made on the basis of book profit, then the book profit so assessed if such book profit so assessed is more than the book profit is more than the basic assumption limit, right? In case of reassessment, the underreported shall be the book profit so reassessed if such reassessed book profit are more than the book profit as assessed earlier. Okay. Now it says a person would be considered to have underreported his income if the income assessed or reassessed has the effect of reducing the loss or converting such loss into income. If the loss has been reduced or the loss has been converted into income, in such case also there is a underreported. Okay. Now we'll compute the quantum of underreporting, right? Underreporting of income. Where return was furnished and assessment is made, then the underreported income shall be the income assessed as minus the income determined under section 143(1), where no return of income has been filed. Then the underreported income shall be income assessed minus basic assumption limit. But in case of person other than individual, HUF, AOP, BOI, RTH, there is no basic assumption limit. So in such case, underreported income shall be the assessed income. Where there is a case of reassessment, then the income reassessed as minus income already assessed earlier. And where the underreported income arises out of determination of deemed total income in accordance with the MAT or AMT provisions. The underreported income shall be A minus P plus C minus D. A means the income assessed under regular provision. B means income which was determined under section 143(1) or earlier assessed, okay, under regular provision. C means book profit assessed now. D means book profit earlier assessed or furnished in the return of income earlier. So addition of these two is the underreported income. And where the assessment or reassessment of the case maybe has the effect of reducing the loss or converting the loss into income. Then the book profit, the underreported income shall be the loss claimed minus income or loss as the case may be assessed or assessed earlier. Okay. Okay. This is interesting. It says, assuming there were additions made in earlier years. Okay, in the earlier years. But there was no penalty was levied in such years on such additions. Why? Maybe for this we call intangible additions. Okay. The addition made earlier year and penalty was not levied at that time. Now, if any receipt is found and the assessee claim that this is the same amount which has already been added to my income in earlier years, right? It can happen. Then the law says that in a case where source of receipt appearing in the current assessment year is claimed to be an amount added to the income in the assessment of such person in any earlier assessment year or years, and no penalty was levied on such preceding year, then underreported income shall include such amount as is sufficient to cover such receipt, deposit, or investment. So what it means? Then such receipt and shall be considered as an underreported income of the first of the preceding year in which any such addition was made. So it says, such amount shall be deemed to be the amount of income underreported for the preceding year in the following order. So first of the preceding year shall first be utilized, then subsequently we go backwards. The preceding year immediately before the year in which the receipt appears be the first preceding year, and then we go backwards. In following cases, 270 subsection 6 says that in following cases, it shall not be deemed that there is an underreported income. Okay. So there will be no penalty in following cases. One, where the amount of income in respect of which the assessee offers an explanation and the explanation, AO finds the explanation, AO is satisfied with the explanation that the explanation is a bona fide and all material facts have been disclosed to substantiate the explanation, right? Or where the amount of underreported income determined on the basis of an estimate, but the income tax authority is satisfied that the accounts of the assessee are maintained completely and the method employed such that income cannot be reduced therefore. Okay, so because of that, the authority has to make an estimate. The amount of underreporting income determined on the basis of an estimate, and the assessee had already estimated his income, but the AO finds that such an estimate is not proper or is a lower. The assessee has its own estimated lower amount of addition or disallowance on the same issue and has included such amount the computation of his income and disclose all the facts material to the addition. Okay. So in all these cases, where the assessee offers an explanation or where the addition is made on the basis of estimate, but the assessee had already disclosed all the materials, or where the amount of underreported income is represented by any addition made in conformity with the arm's length price, or where the amount of undisclosed income is on account of such. In these cases, penalty is not liable under section 270 capital A, it is liable under any other section, which we will see. Misreporting, 270 A capital line, subsection 9. 270 capital A subsection 9. It's very important. The 270 capital A subsection 1 is underreporting. Then 270 capital subsection 9 says, if the underreporting is on account of the reason specified therein, then it will be a case of misreporting. And the penalty in case of underreporting is 50%, but in case of misreporting, it is 200% of the tax. So if your case fall under misreporting, then the penalty shall be levied twice the tax amount. Okay. So what are the cases? If there is a misrepresentation of suppression of facts, right? If there is a failure to record investment in books of account and AO finds it, if any expenditure is claimed which is not substantiated by any evidence, if there is any false entry recorded in the books of account, if the assessee has failed to record any receipt in the books of account having a bearing on total income, if assessee failed to report any international transaction deemed international transaction or HDT under Chapter 10, transfer price. So in all these 6 cases, in any of these 6 cases, if the underreported income is on account of any of these 6 cases, they will be deemed as misreporting and a higher penalty shall be levied. Now see the quantum. If it's a case of underreporting, the penalty is 50% of the tax payable on the underreported income. However, if it's a case of misreporting, as we discussed above, then the penalty shall be 200% of tax payable on such underreported income or misreported income. Now, how we compute tax on underreported income? Where no return of income has been furnished, or where it, then the tax shall be whatever is the underreported income, it shall be increased by the basic assumption limit, and tax on such amount shall be computed. Right? Where total income determined under section 143(1) in a preceding order is a loss. Then in such case, tax payable in respect of underreported income shall be the amount of tax calculated on underreported income as if it was the total income. So if earlier it was a loss, now the loss has reduced or it has been converted into income, then the tax on underreported income shall be the difference. The tax on the, see earlier it was a loss of 5 lakh. Now in the assessment, loss has been reduced to 2 lakh. Then the underreported income shall be 3 lakh, and tax on this 3 lakh shall be deemed as a tax on underreported income. In any other case, means tax on the income so assessed minus tax on the income determined under section 143(1) or any of the preceding order. Okay. So difference of the tax on the both the incomes. (273) capital. It's important. So section 273 capital A gives a power to principal commissioner or commissioner to reduce or waive the penalty. Okay. There are 2 subsections. 273 capital A 1 273 capital A4. Both the sections give power to PCIT or CIT to waive or reduce the penalty, right? But both are different sections. We'll see. So, firstly, 273A subsection 1. So, who it authorizes? PCIT or CIT to reduce or waive the penalty imposable under section 270 capital A. Okay. Under this section, the PCIT or CIT can, on its own motion, they can act, they can reduce or waive the penalty on its own motion, or they can, of course, act on the application made by the assessee. Okay. But to waive or reduce the penalty, some condition has to be fulfilled. What is that? First is true and true disclosure, and that too before the detection by the assessing officer. Assessee must have made full and true disclosure, and that disclosure must be made before detection by the assessing officer. Assessee must have cooperated in the inquiry with the department, and the assessee must have paid or have made have made satisfactory arrangement for the payment of tax and interest due. Okay. If all these three conditions are satisfied, then the PCIT or CIT may reduce or waive the penalty. However, they have to take the approval of their seniors, meaning principal chief commissioner, principal director general or director general, where the income exceeds 5 lakh. Okay. So we are talking about the income in respect of which the penalty is levied. If such income is up to 5 lakh, then no approval is required. But if income in respect of which penalty is levied exceeds 5 lakh, then the approval of chief commissioner or director general is required. Okay. Important point. 273A subsection 1 is available only once in a lifetime. If assessee has availed it once in a lifetime, it cannot avail anytime thereafter. Okay. Now we comes to 273A subsection 4. Here also, the principal commissioner or commissioner are authorized, but here they can act only on the application made by the assessee. You remember under 273A subsection 1, they could have act on their own motion, but in 273A subsection 4, they can act only on the application made by the assessee. In under section 273A subsection 4, they are empowered to even stay or compound any proceeding for recovery of any penalty in case where he is satisfied. So what are the condition here? The condition is he should be satisfied that to do otherwise would cause genuine hardship to the assessee. That if the penalty is not waived or reduced, such an act will cause genuine hardship to the assessee, and the assessee has cooperated in any inquiry relating to the assessment or proceeding for recovery of penalty with the department. So two conditions. So they must be satisfied that if the relief is not given, then that will cause genuine hardship to the assessee, and the assessee has cooperated. Again, 273A subsection 4 is not once in a lifetime. That was 273A subsection 1. Right? In this case, the PCIT or CIT must pass the order within 12 months from the end of the month in which application received by it. Okay. Like 273 subsection 1, here also they are required to take the approval of their seniors, meaning chief commissioner or director general. How the approval is required only if the quantum of penalty exceeds 1 lakh. If the quantum penalty is up to 1 lakh, then no approval is required. If the quantum penalty exceeds 1 lakh, then they are required to obtain the approval. Also, if the application in respect of multiple penalties, then this 1 lakh has to be seen aggregate in respect of all such penalties. So this 1 lakh is in respect of an application. Okay. The order passed by principal commissioner or commissioner under section 273A, whether accepting or rejecting the application of assessee, is a final order, meaning there is no appeal against it. Now, just see how we compute underreported income and tax thereof. we say there's a XYZ is a firm, partnership firm, which is liable to tax 30%, of course. The following are the particulars. It furnished return of income and it showed 50 lakh income. However, in the processing, the income increased to 60 lakh. So there is no penalty on this 50 to 60 lakh because there is no penalty in case the income is increased under section 143(1) at the time of processing of return. Okay. But now in the assessment, the income increased to 75 lakh. So this 15 lakh forms underreported income, right? And in case of reassessment, the income further increased to 90 lakh. So again, 15 lakh form part of underreported income. 90 lakh minus 75 lakh. Okay. And the tax on this 15 lakh shall be a tax on underreported income. And if it's a case of underreported, then 50% of such tax shall be penalty. And if it's a case of misreporting, then 200% of such tax shall be the penalty. Okay. So in case of assessment, the underreported income is 15 lakh. Then tax payable on 15 lakh is how we compute. We first compute tax payable and on 75 lakh, and then we reduce the tax payable on 60 lakh. So this comes the tax payable on 15 lakh, and 50% of this is a penalty, assuming it's the case of underreported. Similarly, in the case of reassessment, this was 95. So 20 lakh was the underreported income. Now, how we compute the tax? First, we'll compute tax on 95 lakh, and from that amount, we will reduce tax on 75 lakh. So we'll get the tax on underreported income, which is 6,24,000, and 50% of this is the penalty, assuming it's a case of underreporting. Mr. Ram is a resident individual of the age of 55 years, has not furnished his return of income for 26-27. Okay, so they have not furnished return of income. However, the total income assessed in respect of such year under section 144 is 14 lakh. Okay, so best judgment assessment was made and the income was assessed 14 lakh. But return was not furnished. Okay, so in this case, if the income assessed exceeds the basic exemption limit, then it's the case of underreporting. And is the penalty under section 270 capital is attractive in this case? Yes, because it's a case of underreporting. And what is the quantum of the penalty? So, how you compute the penalty? You will compute a tax on 14 lakhs, and 50% or 200% of the case may be of this tax shall be the amount of penalty. Now it's a case of a loss. So the company, it furnished a return of income with a loss of 15 lakh. However, at the time of processing, the loss reduced to 8 lakh, no penalty. But in the case of assessment, the loss further reduced to 5 lakh. Now this 3 lakh is the underreported. In case of reassessment, the loss converted into income of 4 lakh. Now this 9 lakh is the underreported. Okay. So in case of first assessment, 3 lakh, or tax on underreporting income is 78,000, and the penalty shall be 50% or 200% as the case may be. Now, in the case of reassessment, this 9 lakh is underreported income, and penalty shall be 50% of the tax on this 9 lakh. Now, this completes our 270 capital A, right? Now we move to other penalty sections. There are a lot of penalty sections, which you must have studied in different chapters where the relevant provisions are discussed. So, wherever the relevant provisions are discussed, the study material discusses the penalty associated with if the assessee does not comply with such provisions. But here, we have accumulated all these penalties, and we just very quickly see what all penalties are there. So first is 271 capital A. It is levied for if the assessor has failed to keep or maintain books of account as required under section 44 AA. The penalty is an amount equivalent to 25,000 rupees. In case of 271 AA subsection 1, then the default is if assessee failed to keep and maintain any information document as required under section 92D, the transfer pricing report, the penalty is equal to 2% of the value of international transaction or specified domestic transaction SGT. Right. 271 AA subsection 2. If the assessee failed to furnish the information document as required in section 92D4, The penalty is 5,000 only. 271 double AD, important section. It says in the default is that penalty for false entry in the books of account or omission of any entry which is relevant for computation of total income of such person to evade tax liability. The false entry includes any forged or falsified document, such as false invoice or general or a false piece of documentary evidence, or invoice in respect of supply or receipt of goods or service where such goods or service were never received, or invoice in respect of supply of receipt of goods or service from a person who does not exist. All this case comes under the false entry. In this case, the penalty is equal to the amount of false entry, right? But such penalty is leviable on the person who makes such false entry and any other person who caused the person in any manner to make such false entry. Not only to the person who makes such false entry, but also on the person who encouraged the other person to make such false entry. Okay, 271 double AD. Now 271 double AE. If any trust or institution is registered in section 1023C, 4, 5, 6 or 6A, or section 11 and 12, and it gives any benefit to a specified person referred to in section 13.3, then the penalty is 100% of the amount of income so applied. Yeah. But if there is a repetitive default, if there is a second default, then the penalty is 200% of the amount. 271 capital B is a penalty for failure to get the books of account audited as required in section 44AB. The penalty is 0.5% of the turnover or rupees 1,50,000, whichever is less. Meaning the maximum penalty is 1,50,000. 271 BA. Failure to furnish TP certificate under section 92E. The penalty is 1 lakh. 271 capital C. Failure to deduct tax at source as per chapter 17B or to pay or ensure payment the whole or any part of the tax. Then the penalty is equivalent to the amount of tax he failed to deduct or pay, as the case may be. Similar to 271 capital C, there is a section 271 capital CA. In 271 capital C, it was a penalty for failure to deduct or pay the TDS. Here the penalty is for failure to collect or pay the deposit the TCS. Similarly, the amount of penalty is equal to the amount of tax he failed to collect. Now, there are some section regarding cash transaction. 271 capital D is a penalty for failure to comply with the provision of 269 double SS. Double S. Penalty is equal to the amount of loan or deposit or specified sum taken or accepted otherwise than by account pay check or banking channel. 271 DA for failure to comply with the provision of 269 HT. Penalty is equivalent to the sum received in contravention of the provision of 269 HT. So equivalent to the amount received. Then there is 271 DB. It is for contravention of provision of 269 SU. Penalty is rupees 5,000 per day in case of continuing default. So 269 SU says that the assessee has to provide the facility for receipt of banking receipt for accepting the receipt through banking channel. If the assessee failed to provide such facility, the penalty is equal to 5,000 per day. 271 capital E. So this is a penalty for non-compliance of the provision of 269T. In this case also, the amount of penalty shall be equal to the amount of loan or deposit specified advance repaid, otherwise than through banking channel. 271 FA. Okay, now we are coming to default in compliance with the provision of section 285 BA. So 271 FA says that it is a failure to furnish statement of financial transaction or reportable account within the time prescribed in section 285 BA subsection 2, that is on or before 31st May of the immediately close of the financial year, for the financial year. Then there is a penalty of 500 per day during which failure continues. However, if the failure continues even after the notice, then the penalty shall be 1,000 per day during which the failure continues. 271 FAA subsection 1. It is also in respect of furnishing of incorrect information in the statement of financial transaction or reportable account, or failure to furnish correct information within the period specified. Then the penalty is equal to rupees 50,000. Then subsection 2 of 271 FAA says that if the assessee fail to furnish inaccurate, if assessee furnishes inaccurate statement of financial transaction or reportable account, and the inaccuracy is due to the false or inaccurate information furnished by the holder. The assessee is not in default. The inaccuracy was on account of the information submitted by the holder of the relevant reportable account. Then no penalty is levied. Penalty equal to the 5,000 for every day in addition to penalty of 50,000 levied above. Okay. It's levied on the assessee. But the assessee is entitled to recover the sum so paid on behalf of such reportable account holder or retain out of the money that may be in its possession or may come to it from every such reportable account holder. Okay. So though the government will collect the penalty from the assessee may again collect it from the reportable account holder. In case of eligible investment fund, they are required to furnish a statement of Section 9 capital A. If they fail to furnish the statement within prescribed time, then the penalty equivalent to rupees 5 lakh. 271 capital G. If the assessee failed to furnish information document under Section 92D3, the penalty is equivalent to the 2% of the value of international transaction. 271 GA. If the Indian concern failed to furnish the statement or information referred to in Section 285 capital A, the penalty is equal to the 2% of the value of transaction if the transaction has the effect of transferring the right of management or control of such Indian concern. In any other case, the penalty is equivalent to the amount of 5 lakh. 271 GB. It's regarding CBCR, country by country reporting. If there is a non-furnishing of report by any reporting entity, which is required to furnish country by country report as required in Section 286, then the penalty depends upon the delay. If the period of delay is up to 1 month, then penalty is 5,000 per day. If it is beyond 1 month, then it is 15,000 per day for the period exceeding 1 month. And if even after the notice the report is not submitted, the penalty is 50,000 per day of continuing default beginning from the date of service of order. Okay, so if it's within 1 month, the penalty 5,000, beyond 1 month, 15,000, and beyond the order, 50,000. Mm. 271 GC. Failure to furnish statement under Section 285. The penalty is 1,000 per day for the period of default if the period of default does not exceed 3 months or 1 lakh in any other case. So if the period of default is up to 3 months, then 1,000 per day. Or if the period of default exceeds 3 months, then 1 lakh. 271 capital H. If the assessee failed to furnish TDS or TDS statement, TDS return, the penalty is equal to 10,000 to 1 lakh. However, no penalty is levied if the person had delivered the TDS or TDS return before the expiry of 1 month from the time prescribed. Okay. So a grace period of 1 month is given. However, if a assessee furnished incorrect information in the TDS or TCS return, then also there is a penalty of 10,000 to 1 lakh. When there is a range, then it's up to discretion of the authority levying the penalty, whether it want to levy 10,000 or 1 lakh or any amount in between. Okay. 271 capital I. So if the assessee failed to furnish information or furnishes inaccurate information under Section 195(6), It is the section where we are required to furnish Form 15CA, 15CP. The penalty is equivalent to the amount of 1 lakh. 271J. If if there is an incorrect information in a report or certificate furnished by an accountant, it includes report furnished by chartered accountants also, then there is a penalty of 10,000 for each such report. 271 capital K. If you know, there is a requirement on institution, association, or body referred to section 35 or ATG to furnish a statement. So if they fail to deliver or cause to be delivered statement within the time prescribed under section 35(1), or if they fail to furnish a certificate prescribed under section 35(1)(a)(2), or in case of charitable religious organization, they fail to deliver the statement within time prescribed under ATG 5 or a certificate under section ATG 5(9), then there is a penalty equivalent to the amount of 10,000 to 1 lakh. 272A subsection 1. If any assessee refuse to answer any question put to it by the income tax officer, or refuse to sign statement made in the course of income tax proceeding, or it non-comply with the summon issued under section 131, or it fail to comply with the notice issued under section 142(1) or 143(2), or failure to comply direction under section 142(2)A, there is a penalty equivalent to the 10,000 for each such default. 272A subsection 2. In this case, there is a penalty of 500 per day. What all defaults are referred herein? If you fail to comply with the notice under section 94(6), if you fail to give notice of discontinuance of business under section 176, if you fail to furnish within the due time the statement mentioned section 133, 206, 206C, or 285D, if you does not allow inspection of register referred to in section 134, if you fail to furnish return section 139 4A or 4C, 4A is for charitable organization, 4C is for organization whose income are exempt under section 10. You fail to furnish certificate as required under section 203 or 206C, TDS or TCS certificate. If you fail to deduct and pay tax under section 226(2), if you fail to furnish statement as required under section 192(2)C, if you fail to deliver cause to be delivered in due time, a copy of declaration referred to in section 206C(1)A, so that TCS is not required to be collected. If you fail to deliver statement within the prescribed time specified in section 206A, 202A, and 206C, 3A, or you fail to deliver the declaration of section 197A to the income tax authority. In all these cases, there is a penalty equivalent to the amount of 500 per day, during which the failure continues. 272AA. Failure to comply with the provision of section 133B, then the penalty is equivalent to the amount up to 1,000. 272 capital B. It's regarding the PAN. If the assessee failed to comply with the provision 139A, then penalty is equivalent to 10,000. If it failed to quote or intimate PAN or Aadhaar number in the document referred therein, then the penalty is rupees 10,000 for each such default. Or it failed to authenticate the PAN in accordance with 139A 6A, then again penalty is equal to 10,000 for each such default. 272BB. If the assessee failed to comply with the provision 203A TAN number, or failed to quote the TAN wherever it was required, then also there is a penalty of 10,000. So clear? These all are penalty which we study at different places. Wherever we study the PAN, we discuss the penalty under section 271H. Wherever we study TDS statement, we discuss the penalty related thereto. In case of search also, we discuss the penalty. In case of transfer pricing, we discuss the penalties. So all these penalties are discussed in different places in the study modules. But here we have aggregated it. We have shown the complete penalty so that you can revise it easily. Now we are moving to undisclosed income. So the Act has come very heavily on the assessee who have undisclosed income. Okay. So there are uh, 6 sections which deal with undisclosed income. And if any addition is made in any of these 6 sections, the tax is levied at the rate of 78%, which we will see on the income so added. So on the addition so made. So, and not only this, on this addition, there is also a penalty of 10%. So whatever is the addition, almost entire amount gets wiped off. Okay. The addition is made in any of these 6 sections. The first section is cash credit. Section 68. What it says, if any amount is found credited in your books of account and the assessee could not offer the explanation to the satisfaction of the A, then such amount shall be added in section 68. Any sum is found credited in the books of the assessee and the assessee offers no explanation about the nature and source of such credit, or the explanation so offered by it is not satisfactory in the opinion of AO, then sum so credit shall be charged as income of the assessee of that previous year, okay, in which the amount so credited. So if any amount is found credited in your books of account, then you must explain the nature and source of such credit to the satisfaction of the year. Not only this, if such amount so credit is in the form of loan or borrowing, then not only that you have to explain the nature and source, but also the person is in whose name such amount is credited. Such person also has to prove the nature and source of such amount in his hands. So it says, where the sum so credit consists of loan or borrowing or any such amount by whatever name called, any explanation offered by the assessee in whose book such sum is credited will not be deemed to be satisfactory unless the person in whose name such credit is recorded in the books of such assessee also offers an explanation about the nature and source of such sum. So unless the person against which, in the name of which such amount is found is credited in the books of account, such person also required to explain the nature and source, and such explanation should be satisfactory in the opinion of you. So if I have taken any loan from you, so such loan amount shall be credited in my books of account. Then at the time of my assessment, I have to explain the nature and source of this loan amount, this credit entry. And not only this, you also have to explain the nature and source of this amount in your hands. Only in that case, my explanation will be deemed to be satisfactory. If I explain, but you cannot explain, then such explanation shall not be deemed to be satisfactory even in my hands. Understand? So we call it source of source. So I have to explain my source, and my source also has to explain his own source. And explain share capital or premium. So similar to loan and borrowing, here also the source of source provision is applicable, but it applies only in case of a company which is closely held company. It doesn't apply in case of company in which public is substantially interested. Okay. So if any amount is credited by a share capital or premium in the books of closely held company, then such closely held company has to explain the nature and source. And not only this, if such amount credited in the name of a resident, then such resident is also required to explain the nature and source of such amount in his end. And such explanation should be satisfactory to the AO. However, this provision are not applicable in case of venture capital fund or venture capital company. Now we move to unexplained investment, section 69. It says, when any fund, so if any unexplained investment is found, then such investment shall be deemed to be the income of the assessor. So what it says when any financial year immediately preceding the assessment year, the assessee has made investments which are not recorded in the books of account of the assessee. So there is an investment which are unrecorded, and assessee offers no explanation, or the explanation so offered is not satisfactory in the opinion of assessing officer, then the value of such investment shall be deemed to be the income of assessee for such financial year. Clear? Next section comes section 69A, unexplained money. If assessee is found to be the owner of any money or bullion valuable article, and he could not explain the nature and source of such money bullion article, then the fair market value of such money bullion shall be deemed to be the income of the assessee. So it says, when any financial year the assessee is found to be the owner. So important is he has to be the owner of money bullion, jewelry, or the valuable article, and same is not recorded in his books of account, and the assessee offers no explanation about the nature or source of such money bullion, jewelry, article, or the explanation so offered is not satisfactory. Same. Then the money and the value of such bullion, etc., shall be deemed to be the income of the assessee for such financial year. But for section 69A to be invoked, the assessee must be the owner. If he only possessed, he only hold the possession of such asset, then addition cannot be known. Addition can only be made on the owner of the asset. Okay. Under section 69, the whole of the investment was not recorded. Under section 69B, if part of the investment is not recorded, it says amount of investment not fully disclosed in the books of account. So in wherein any financial year, assessee had made investment or found to be the owner of any bullion, jewelry, or the valuable article, and the AO finds that the amount spent on making such investment or in acquiring such bullion article exceeds the amount recorded in the books of account. So whatever you have recorded less than the amount you have actually incurred for acquiring such investment or the valuable article. And the assessee does not offer any explanation or the explanation so offered is not satisfactory, then the excess may be deemed as the income of the assessee for such financial year. Okay. 69C, unexplained expenditure. If the assessee has incurred any expenditure and he could not explain the source of such expenditure, then such unexplained expenditure shall be deemed to be the income of, the assessee. Okay. And such unexplained expenditure is also not allowed to be deducted against any income under the Act. So it says, when any financial year assessee has incurred an expenditure and he offers no explanation about the source of such expenditure, or the explanation so offered is not satisfactory in the opinion of the AO, then AO can treat such unexplained expenditure as the income of the assessee for such financial year. Such unexplained expenditure which is deemed to be the income of the assessee shall not be allowed as deduction under any head of income. Clear? Amount borrowed or repaid on hundi, section 69D. So if you have borrowed or repaid any amount on hundi, then the amount of loan, amounts so borrowed or repaid as a case may be treated as the income. But if the amount is once treated as the income at the time of borrowing, then at the time of repayment, it shall not again be treated as the income. As I said, 69D. So what it says, when any amount is borrowed on a hundi or any amount due thereon is repaid other than through account paid check, the amounts of borrowed or repaid shall be deemed to be the income of the person borrowing or repaying the amount for the previous year, even the amount was so borrowed or repaid. However, where any amount borrowed on a hundi has been deemed to be the income of the person, he will not again be liable to be assessed in respect of such amount at the time of repayment. The amount repaid shall also include interest paid on the amount borrowed. So total amount shall be added. Okay. So all this addition can be made towards unexplained income or credit or expenditure, right? Or investment. If any addition is made, then tax is levied under section 115 BPE. Okay. And tax is levied at the rate of 60%. Plus, there is a mandatory surcharge at the rate of 25% and cess at the rate of 4%. So it amounts to 78%. 60 plus 25 plus 4. So if any addition is made under this section, there is a tax liability equivalent to the amount of 78% of the addition so made. Also, against this income, no basic exemption or allowance or expenditure is allowed by the assessee under any provision of the Act in computing such deemed income. Further, No set-off of any loss shall be allowed against income brought to tax under this section. So these income are taxed flat at 78%. And not only this, penalty is also levied at the rate of 10% of the tax, so computed under section 115 BE. However, penalty is not levied if the assessee had disclosed this undisclosed income in their return of income and have paid the tax and the interest. So it says no such penalty would be levied on such income to the extent that same has been included by the assessee in the return of income furnished under section 139 and tax in accordance with section 115 BBE has been paid on or before the end of relevant previous year. Okay. If assessee has included such income under in the return of income and has paid the tax of 78%, then penalty may be waived. Section 273, capital B. Very important section, though very small, but practically it's used a lot. It says it's a possibility of being good or the autumn pattern. It says that penalty is not leviable under all these sections which we discussed in the table just above. The penalty is not leviable if the assessee proves that there was a reasonable cause of the said failure. So penalty is levied only if there was no reasonable cause. If there is any genuine reasonable cause, and because of that reason the assessee could not comply with the provision, and if assessee explains such cause and AO is satisfied, then the penalty is not levied. Okay. Now, who can levy the penalty? So it says any authority who is levying the penalty is required to obtain the approval of Joint Commissioner if the penalty is levied by income tax authority and the amount of penalty exceeds 10,000, or if penalty is levied by assistant or deputy and the amount of penalty exceeds 20,000. In these cases, they are required to obtain the approval of Joint Commissioner. Similar to assessment, there is a faceless scheme of penalty as well. Now, time limit for imposition of penalty, which is given under section 275. So by what time the penalty can be levied? Okay. So if the penalty order is passed beyond this time, it will be invalid. Yeah. So it says the penalty order cannot be passed after the expiry of 6 months from the end of the quarter, not from the end of the year, not from the end of the month, from the end of the quarter in which. So what will happen is that if there is an assessment made and penalty is required to be made on account of satisfaction recorded in the assessment proceedings, then the penalty has to be levied within 6 months from the end of the quarter in which the proceeding in the course of which action for imposition penalty was initiated. However, assuming the such assessment order has been appealed, then the time limit of 6 months from the end of the quarter has to be seen from the date when the order is received, appealable order is received by the PCIT or CIT. Or it may be a case that the assessment order is subject to a revision. Then the time period of 6 months from the end of the quarter is to be seen from the date the revisional order is passed by the PCIT or CIT as the case may be. So you're getting the point. So what happened is that if there's an assessment order, right? And assessee has not filed any appeal against the assessment order, then the period of 6 months from the end of the quarter has to be seen in which this assessment order was passed, because the action for imposition of penalty is initiated under this assessment order. But if assessee has filed an appeal against the assessment order, maybe before the CIT appeal or ITAT after the CIT appeal, then this 6 months from the end of the quarter is to be seen from the date when the appealable order, as the case may be, CIT or ITAT, is actually received by PCIT or CIT. So proceedings have been finalized. Or assessee can also go to revision before PCIT or CIT against this assessment order. In this case, the period has to be seen from the date of passing of revision order by these authorities. Okay. So it says no order imposing a penalty shall be passed after the expiry of 6 months from the end of the quarter in which proceeding in the course of which action for imposition penalty has been initiated are completed. If the order is not subject to matter of any appeal. Okay. Or 6 months from the end of the quarter in which order of revision under section 263 or 264 is passed by the PCIT or CIT, or the order of appeal under section 246 or 246A is received by PCIT or CIT, or the order of appeal under section 253 ITAT is received by the jurisdictional PCIT or CIT. Or in any other case, if it's not a case of penalty initiated through assessment order. In any other case, any other penalty, the penalty is to be levied within 6 months from the end of the quarter in which notice for levying such penalty was first issued. Okay. So this is section 275. However, the following time period, as always, also excluded while computing the above period of 6 months. First is the period time taken in giving an opportunity to assessee to be reheard under the proviso rule section 129 if there is a session of tax officer, and period commencing on the date on which stay on proceeding to levy penalty was granted by an order or injunction of any court, and ending with the date on which certified copy of order vacating the stay was received by PCIT or CIT. So during which the proceeding will remain stayed, such period shall also be excluded while computing the limitation period of 6 months. Okay. So this completes our penalty provisions. Okay. Now we move to the prosecution. Prosecution means, okay, first understand that it's not necessary that if there's a, in case of one default, if there's a penalty provision, then prosecution cannot be levied. In case of same default, there can be penalty, and at the same time, there can be prosecution. Okay. So there are some prosecution provisions. First is 275 capital A. It says that if there's a contravention of the order made under second proviso to section 132.1 and 133.3 regarding search and seizure, then there's a prosecution with rigorous imprisonment up to 2 years plus fine. 275B. If the assessee failed to afford the authorized officer in case of search the necessary facility to inspect the books of account or other document as required under section 132, the penalty is equivalent to the prosecution is for rigorous imprisonment for 2 years plus fine. Under section 276, if there is a removal, concealment, transfer of or delivery of any property to thwart tax recovery, then there's a rigorous imprisonment up to 2 years plus tax plus fine. 276B. If the assessee failed to pay to the credit of central government TDS, then there's a rigorous imprisonment of 3 months to 7 years plus fine. However, if the payment has been made to the credit of central government on or before the time limit prescribed for filing the TDS return, then no prosecution is attractive. So, if there's a delay in payment of TDS, then there is a prosecution provision. So, you know the TDS has to be deposited every month. So, if there's a delay, then there's a prosecution provision. But it says that no prosecution shall be initiated if that amount, that TDS has been deposited by the due date of furnishing return of TDS return, meaning quarterly. 276BB, similar to TDS, if the assessee failed to pay TCS collected by it, then there's a rigorous imprisonment from 3 months to 7 years plus fine. However, the above provision shall not apply if the payment of tax collected has been made to the credit of central government on or before the time prescribed for filing TCS return. Okay, similar to TDS. If there is a willful attempt to evade tax, penalty, or interest chargeable, imposable under report of his income, then the regress and the evaded amount or tax on under-reporting income exceed 25 lakh, the prosecution is for 6 months up to 7 years plus fine. In any other case, it is 3 months to 2 years plus fine. If there is willful attempt to evade payment of tax, penalty, or interest, then there is a prosecution for 3 months to 2 years plus fine at the discretion of the court. Okay. 276 important. If there is a willful failure to furnish in due time a return of income section 139(1) or 142(1) or 148, then if the evaded tax exceeds 25 lakh, then the prosecution is for 6 months to 7 years plus fine. Or if the evaded tax is less than or up to 25 lakh, then the prosecution is for 3 months to 2 years. Okay. However, if the return of income under section 139(1) is furnished before the expiry of the relevant assessment year, or an updated return is furnished within the time specified under section 138A, or tax paid by a person not being a company, so this benefit is not given to a company. If tax paid by a person on the total income determined on a regular assessment does not exceed 10,000, then in such case there is a no prosecution proceedings. Okay. If you have furnished a return of income by the end of the assessment year, or if you have furnished return updated return within the provision of 139(8)(a), or if the tax so assessed in your case is up to 10,000, then even if there is a provision for prosecution for non-filing or return of income, such provision shall not be attracted in your case. Clear? (276) willful failure to furnish in due time a return of income in such cases under section 158 BC, then there is a prosecution of 3 months to 3 years plus fine. 276D, willful failure to produce accounts and document under section 142(1) or 142(2)(a), then there is a prosecution up to 1 year plus fine. And 277, false statement in verification. If the assessee furnish a false statement verification, and if the evaded tax exceeds 25 lakh, then the prosecution is 6 months to 7 years plus fine. In any other case, it is 3 months to 2 years plus fine. 277 capital A, falsification of books or document to induce or abate. To induce or abate any person to evade any tax, penalty, or interest chargeable and imposable under this act. It is not necessary to prove that the other person has actually evaded any tax, penalty, or interest chargeable under or imposable under the act for the purpose of establishing a charge under this section. So if any person induce or abate any other person to evade tax, interest, or penalty, as the case may be, then such person can be imprisoned for 3 months to 2 years plus fine. Clear? 278, abatement of false return relating to income chargeable tax. If the evaded tax exceeds 25 lakh, then 6 months to 7 years. In any other case, it's 3 months to 2 years. Now it talks about the subsequent offenses. If there is a second subsequent offense under section 276B, BB, C, double C, 277 to 78, as we discussed above, then the prosecution shall be for 6 months to 7 years for every subsequent offense plus fine. Section 280, disclosure of particulars by public servant in contravention of section 138(2), prosecution after previous sanction of central government in section 280. And then the prosecution shall be for up to 6 months plus fine. Okay. If the offense, for the purpose of offense and prosecution, following individuals shall be deemed to be guilty of the offense committed by the respective person. If the offense is committed by a company, then who shall be deemed to be guilty? Every person in charge of affairs, director, manager, secretary, and every officer who is guilty of an offense. So along with the company, all these officers shall also be deemed to be the guilty of the offense. If the offense is committed by the firm, then the partner, all the partner of the firm shall be also be deemed to be the guilty of the offense. If the offense is committed by the AOP or BOI, then members controlling the affairs. If the offense is committed by the HUF, then karta or member either by acquiescence or negligence. Presumption as to culpable mental state. So what happened is that in case of prosecution, there has or penalty also, there has to be a malified intention. A mistake does not arise to a penalty of prosecution, but a fraud does. So what is the difference between mistake and fraud? In a fraud, there is an intention to commit a crime. You know? The crime is committed with full knowledge and with an intention to commit. So this is called malified intention. Okay. So the law presumes that if any default has been incurred, it was incurred with full intention. And the assessee has to prove with documents the otherwise. So the onus to prove that there is not a culpable mental state is on the assessee. It's not on the department, because now under section 278E, the court has to presume that the person doing the default, making the default, is having a culpable mental state. Okay. Onus of proof is on the accused, not on the department. If any proceeding which requires a culpable mental state on the part of the accused, the court shall presume the existence of such mental state. So the court shall presume, it's a presumption that the default was made intentionally. But it shall be a defense of the accused. Who has to prove the innocence? The accused has to prove the innocence with the fact that he had no such mental state with respect to act charged as an offense in that prosecution. Clear? It is specifically provided that where any proceeding requires a culpable mental state, mens rea, the court shall presume the existence of such mental state, but the assessee is entitled to prove that no such mental state with respect to the act charged with. So first is onus is on the assessee. Now department does not have to prove that there's a mens rea, but the court will presume the existence of mens rea, and the assessee has to prove the otherwise. Okay. What do we mean by culpable mental state? Culpable mental state includes intention, motive, or knowledge of a fact or belief, or reason to believe a fact. So whatever default is there, it is there with the intention and motive. Also see how the assessee can prove. It says, for the purpose of this section, a fact is said to be proved. Because assessee has to be proved such fact that it does not have a culpable mental state. Such fact can be proved, is said to be proved only when the court believe it to exist beyond reasonable doubt, and not merely when its existence is established by a preponderance of probability. So, court has to be satisfied the existence of such fact beyond reasonable doubt and not on the basis of probability. Okay. Now, the prosecution is to be made at the instance of principal chief commissioner or chief commissioner or principal commissioner or commissioner. Since it's a big step against the assessee, so this step can be taken only with the approval of senior officers. Now there are some guidelines for compounding of offenses. CBDT has issued some guidelines. This is not very much important from exam point of view. How can you get the compounding of your prosecution proceedings? Okay. So we discussed about the penalty and the prosecution. We discussed that the PCIT or CIT has a power under section 273 capital A to waive or reduce the penalty under section 270 capital A. So 273 capital A, 273 capital A gives the power to PCIP oblique CIP to reduce or waive the penalty under section 2 levied under section 270 capital A. Okay, the penalty is levied under section 270 capital A, and 273A gives the power to PCIT or CIP to waive or reduce this penalty. Okay. There were two sections, subsection 1 and subsection 4. So subsection 1 was once in a lifetime, and subsection 4 is not there in such condition. Okay. So under 273 capital A, assessee can approach the CIT or PCIT for reducing or waiving the penalty. But some condition has to be fulfilled. Okay. So what are these conditions? We discussed. Now, there is another section 270 capital in which the assessee can approach the AO, assessing officer, not to the PCIT or CIT, to the judicial tax officer, AO, and request him to waive the penalty under section 270 capital A and also the prosecution proceedings. Okay. So, an option is given to assessee that he can approach the AO and request for the waiver of the penalty. However, there are some conditions which are required to be fulfilled. First, the assessee must pay the tax and interest, right? Such tax and interest must be paid within the time limit, provided in the notice of demand. So, in case of assessment, if there is some addition, then a demand is raised. Demand includes in tax and interest, right? And thus, such demand is raised by way of notice of demand under section 156. And once under such notice, there is a time limit of 30 days by which the amount specified the demand so raised under such notice is to be deposited, is to be paid, right? Now, if the assessee wants to get an immunity from the penalty, he has to pay the amount so mentioned in this notice of demand, which includes tax and interest, within the time limit specified in this notice, that 30 days. And after depositing the tax and interest, it has to make an application under section 272AA to the assessing officer. And not only this, he has to waive his right to appeal. If you are approaching 270 capital A, then you cannot file an appeal against the assessment order, or you cannot go for revision against the assessment order. So you have to forego your right of appeal or revision against the assessment order. Understood? So what we are talking about, either you go for 270 AA or you go for assessment route, appeal route. So if you go for appeal route, then 270 AA you cannot invoke. 270 AA is what? It gives you immunity from the penalty of prosecution if you pay the tax and the interest. Okay. But in such case, you cannot go to the appeal route. But if you have gone for the appeal route, then you cannot make an application to AO under section 270 capital A. But if you want to go for 270 capital A, then you have to satisfy some condition. You have to pay tax and interest within the time limits provided in the notice of demand under section 156. You have to make an application within 1 month from the end of the month in which the order is received before the AO for requesting for granting of immunity from the penalty and the prosecution. And you have to forego your right to appeal or revision. So these 4 things you have to do. And then AO may allow the application and grant you immunity from the penalty. Okay. But remember, one very important thing. Under section 270 capital A, where the AO is granting immunity from the penalty, such immunity can be granted only if the penalty is initiated as underreporting, not in consequence of misreporting. You remember we just discussed in case of underreporting there are 2 types of penalty, underreported and misreported. In case of underreported, there is a 50% penalty. And in case of misreporting, there is a 200% of the penalty, right? Now, 270 capital A, subsection 9, give 6 circumstances where the underreporting of income will be treated as a misreporting, right? Now, the provision says if your case falls under any of these 6 cases, meaning if the if the assessing officer has initiated the penalty in any of these 6 cases, treating the underreporting as misreporting, then you cannot invoke 270AA. Then the 270AA can be invoked only if the penalty is initiated as a consequence of underreporting, not in a consequence of misreporting. Understood? Let's see. Immunity for imposition of penalty and prosecution under section 270 capital. Double capital A. Capital A, capital A. Application to be made by assessee to AO for grant of immunity from penalty and prosecution. So here it's not on its own motion. Assessee has to approach the AO. So an assessee may make an application to the AO for grant of immunity from imposition of penalty under section 270A and initiation of proceeding under section 276C or 276CC. So against whom, in respect of which section the immunity can be granted? Penalty under section 270 capital A or 276C or 276CC prosecution. So if assessee wants to get the immunity against a penalty under section 270 capital A under reporting or prosecution under section 276C or 276CC, then he can opt for 270AA. Remember, 270AA is not a mandatory section. The assessee may opt for it or may not opt for it. If it doesn't opt for it, it can go to the appeal route. But if it opts for it, it cannot go to the appeal route. But for 270AA, some condition has to be fulfilled, which is if he pays tax and interest payable as per the order of assessment under 743(3) or reassessment 147 within the period specified in the notice of demand. If the assessee pays the tax and interest within the period of 30 days as specified in the notice of demand. Okay, so whatever the periods there in the notice of demand, the assessee has paid the tax and interest, which is computed in the assessment order. And very important, he does not prefer an appeal against such assessment or reassessment order. So if you're going for 270AA, if you're going for immunity, then you cannot file an appeal. Time for making an application. The assessee can make such application in the prescribed form and verified in the prescribed manner within 1 month from the end of the month in which the order of assessment or assessment is received. So whenever you receive the assessment order, say on 20th March, you receive the assessment order, then you will end this month, 31st March, and you have to make the application under section 270AA by 30th April, within 1 month from the end of the month in which order is received. If you have received the order on 2nd April, then you can make the application by 31st March. Clear? But the tax and interest has to be paid within the period specified in the notice of demand. So there are 2 different timelines. One timeline is for payment of tax and interest, so determined in the assessment order. Such tax and interest should be paid within the period specified in the notice of demand, and the application is to be made to AO under section 270AA within 1 month from the end of the month in which the order is received. Circumstances where AO cannot grant immunity. So in which cases the AO cannot grant immunity? If you have paid the tax and interest, if you have made an application within 1 month from the end of the month, and you have forgone your right to appeal, then the AO is duty bound to give you immunity. But however, in the following cases, AO can reject your application and shall not give you immunity. Okay, understood? So it's not discretionary provision on AO. If you satisfy the condition, then AO is duty bound to give the immunity. But in the following cases, AO is not duty bound to give the immunity. AO will not give you the immunity. So what all these cases are? It says that AO shall grant immunity from initiation of penalty under section 270A and prosecution under section 276C or double C on fulfillment of conditions specified one above. Meaning, what are the conditions? You have paid tax and interest within the time, you have forgone your right to appeal, and you have made the application within the time prescribed, which is 1 month from the end of the month in which the order is received. And after the expiry of period of filing appeal as specified in section 249. So, the AO shall grant immunity only when the period for filing the appeal has expired. Okay. However, this is to ensure that you cannot go up in appeal against and simultaneously take the immunity from the penalty. However, immunity shall be granted by the AO only if penalty proceeding in section 270A have been initiated on account of the following. Have not been initiated on account of the following. It says that immunity shall be granted only if penalty proceedings have not been initiated on account of misrepresentation or suppression of fact, or on account of failure to record investment in books of account, or on account of claim of expenditure not substantiated by the document or evidence or invoice, or on account of recording of any false entry in the books of account, or failure to record any receipt in the books of account which have a bearing on total income, or failure to report any international transaction or transaction deemed to be international transaction or SDT, specified domestic transaction, which is required under chapter 10. Okay. So all these 6 cases we discussed earlier also. This is what are these cases? These are regarding misreporting. So immunity shall not be granted if the penalty is initiated on account of misreporting. Understood? This we discussed. We have time limit for passing the order. So if any application is made before the AO under section 270 capital AA to grant of immunity, then the AO shall pass the order accepting or rejecting the application within a period of 3 months from the end of the month in which such application is so received by him. However, in the interest of justice, no order rejecting the application shall be made without giving an opportunity of being heard to the assessee. So, audio ultim partem. If the AO accepts the application, then he can pass the order without giving any such opportunity, then opportunity is not required. However, if AO is not accepting the application, is rejecting the application, then before rejecting the application, he has to first give an opportunity of being heard to the assessee. Okay. So, firstly, it says that AO cannot pass an order till the time limit for filing the appeal has expired. Okay. So before that time, AO cannot pass an order. But even after such time, but AO has to pass order within 3 months from the end of the month in which the application is received by him. Clear? Also, the order so passed under section 270 AA is a final order. No appeal under the Act can be made against such order. The only recourse against such order is a rate proceeding or SLP. Okay. Similarly, it again clarify that order of assessment in respect of which application for immunity is accepted is neither appealable before commissioner nor the same can be admitted by the CIT for revision under section 264. So if you have gone for 270 AA route, then you cannot go for appeal or revision route. So they are mutually exclusive. Okay, we discussed it. Either you go for 270 AA or you go for appeal route. Both you cannot take. How it is ensured? The law itself says that SSC has to forego the right to appeal, and then also the AO can pass the order of immunity only once the right to appeal has expired. Okay. Now see, there is a issue. I file an application under section 270 AA. Right. The time limit for filing the application is 1 month from the end of the month in which order is received. Now, and the time limit of filing the appeal to CIT appeal is 30 days from the date of the order, right? So if I have filed an application before the AO under section 270 AA for granting an immunity, So I cannot appeal to CIT appeal. Okay. But what happened is that subsequently, the AO rejected my application of section 270AA. Now, what happened is that my application of 270AA is rejected, and my time limit for filing appeal to CIT appeal has also expired by then, because the time limit available to file appeal to CIT appeal is only 30 days. So it must have already expired. Okay. Now I'm in a fix. I have my application for 270AA is rejected. I cannot file an appeal to CIT appeal. So this is not the intention. Now the law says, see what the law says. It says in any such situation, the time taken in proceedings in 270AA shall be excluded for computing the period of 30 days in which the appeal is to be filed. Okay. So what it says that as per section 249, an appeal is to be made within 30 days of receipt of notice of demand related to assessment of penalty, where the appeal related to assessment of penalty. In a case where assessee makes an application under section 270AA seeking immunity, then following period has to be excluded for calculating the aforesaid period of 30 days. So the for completing 30 days period, the following period shall be excluded. What all period? The period beginning from the date on which application under section 270AA was made and ending with the date on which the order rejecting the application is received by the assessee. If the order is, if the application is accepted, then there is no reason to appeal to CIT appeal, and therefore no reason to no reason to give the no reason to extend the period of filing the appeal, because appeal is not required to file. But if my application is rejected, then the period starting from the day when I made the application up to the date of order rejecting the application, such period shall be excluded, and only after that 30 period time shall be counted. Okay. So this completes my penalty and prosecution. Now we'll have a small break of 10 minutes, and then we'll start with the Black Money Act. So we'll meet on 7:30, 7:40. Okay. Thank you. So we have already discussed penalty and prosecution, right? The provisions related to penalty and prosecution. So now, in addition to penalty and prosecution, there is a very strict act which has been introduced by the government by the name Black Money and Imposition of Tax Law. Okay. So black money, undisclosed foreign income and asset, and imposition of tax Act 2015. So this law is applicable with effect from AY 1617 in respect of whole of the India. Okay. This law is formulated to act as a strong deterrent and curb the menace of black money stashed away abroad by Indians. So the in recent past, there were cases where the Indians have taken out the money out of India and taken out in the countries outside India. So the government has formed this act, and under this act, if the assessee is found to have any undisclosed foreign income or undisclosed foreign asset, then a very heavy tax interest penalties is charged. Okay. So we'll see the overview of Black Money Act. Charge of tax, section 3. It says that every assessee, we'll see the definition of assessee as well. So every assessee would be liable to pay tax at about 30% in respect of his undisclosed foreign income and asset of the previous year. So if there are any undisclosed income or asset, which income or asset? The foreign income or foreign asset. Then such foreign income, undisclosed foreign income and undisclosed foreign asset shall be taxed at the rate of 30%. Clear? However, an undisclosed asset located outside India shall be charged to tax on its value in the previous year in which asset come to the notice of the AO. So section 3.1 said that tax shall be charged of 30% in respect of undisclosed foreign income asset of the previous year. So here it explains that in case of undisclosed foreign asset, that asset shall be charged in the year in which it comes to the notice of AO, irrespective of the fact when it was acquired. You understood? You may have acquired it 10 years before, no issue. But if tax officers come to know now, then it will be taxed now. You cannot say that you tax it in the 10 years before, because the income from which I acquired it was earned 10 years before. No. The law gives an assumption, does a presumption that such foreign asset shall be taxed in the year in which it comes to the notice of the AO. Okay. And such undisclosed income or asset shall be taxed at the rate of 30%. Now, what do we mean by undisclosed foreign income and asset? So, the total amount of undisclosed income of an assessee from a source located outside India. We're talking about the foreign undisclosed income and the value of undisclosed asset located outside India. It shall be deemed to be the undisclosed foreign income and assets. Okay. Undisclosed asset located outside India means an asset including financial interest in any entity, or we hold a shares or partnership interest or LLP interest in any foreign entity located outside India. The asset should be located outside India, which is held by the assessee in his name, or in respect of which the assessee is a beneficial owner, and he has no explanation about the source of the investment in such asset, or the explanation offered by him is not satisfactory in the opinion of the AO. So this provision makes the asset undisclosed. Okay. So it is found that you either the owner or the beneficial owner of any foreign asset, and you could not provide any satisfactory explanation about the nature and source of such asset, then such asset shall be deemed to be undisclosed foreign asset and should be taxed in the year, not in the year in which you acquired it, in the year in which it comes to the notice of the AO. Clear? Okay. Assessee. Who is an assessee? Means who can be taxed under this act. So assessee means a person who is resident in India with the meaning of section 6 of Income Tax Act. Okay. So only resident person can be assessee? No. Assessee can also include a person who is NR or RNOR within the meaning of section 6 is. But if the assessee is NR or RNOR, then he can be assessee only if he was resident in India either in the previous year in which the income undisclosed foreign income relates, or in the previous year in which the undisclosed foreign asset located outside India was acquired. Okay. Now we are talking about the actual part. So it says, who shall be the assessee? Assessee can either be the person who is currently the resident, he is an assessee, full stop. But if the person is currently NR or RNOR, then it shall be deemed as assessee if he was resident, in the year to which the undisclosed foreign income relates, or in the year in which the undisclosed foreign asset was actually acquired by the assessee. If in such year he was resident, then even if he is now non-resident, he will still be deemed as resident or assessee only. Okay. And the year which we are referring as the year of acquisition, here it means the actual acquisition, not the deemed. See, in our case, the asset was acquired 10 years before, though the AO has a power to tax it now, but here we are talking about that he should be resident at that time, 10 years before, when the asset was acquired. Okay. So it said, it has been clarified that person would be assessee if he is resident in the previous year in which the undisclosed foreign asset was actually acquired by him, and not the year in which notice is issued by the AO. Clearly? Though such asset can be taxed currently, but for determining whether the person qualifies as assessee or not, we have to see the registered status in the year in which the asset was actually acquired by. Okay. Previous is section 29. What do you mean by previous year? In case of business newly set up, we know the previous year start from the date when the business was set up and on 31st March. When the new source of income comes into existence, the previous year start from the date when the source of income comes into existence and end with the 31st March. But in case of discontinuance of business, the previous year start from the first day of the financial year and with the date of discontinuance of the business. In any other case, it's 1st April to 31st March. Revenue previous year for chargeability of tax. We discussed this. Undisclosed asset located outside India, undisclosed foreign asset, shall be charged to tax on its value in the previous year, not in which it was acquired, in which the asset comes to the notice of the AO. The asset can be taxed in the year in which it comes to the notice of the AO. Now, if there's any asset, foreign asset, which is undisclosed, what would be the value which is to be determined? Okay, because tax is levied on the value, tax either 30% shall be levied on the value, then what will be the value? Okay, so value of the asset shall be the fair market value of the asset determined in the prescribed manner. This is the most important part of your Black Money Act. How to compute the value of the asset. Okay. So it depends upon the type of the asset. If the asset is bullion, jewelry, or other precious stone, then the fair market value shall be the higher of the cost for which it was acquired and the price that the bullion, jewelry, or this precious stone would fetch if sold in the open market on the valuation date. The fair market value. So the value shall be the cost or the FMV as on to valuation date, whichever is higher. Well, for FMV, you can take the certificate from the valuer. So it says, for this purpose, the assessee may obtain a report from a valuer recognized by the government of that country in which the asset is located, or any agency for the purpose of valuation under regulation of all law. Okay. So if there is any agency which is empaneled with the government of foreign country, then you can take a report from such agency and the value so determined in such report shall be deemed to be the FMV of bullion, jewelry, precious stones, right? And the FMV for black money shall be the higher of the cost or the FMV so determined, right? Similarly, for archaeological collection, drawing, painting, sculpture, any work of art, artistic work, the value for black money shall be higher of similar cost or price that such artistic work would fetch if sold in the open market on the valuation date. Similar to bullion, you can obtain a valuation report here also from any valuer who is recognized by the government of foreign country. Quoted share means the listed shares and securities. The value shall be higher of the cost or the price determined in the following manner. So if they were trading on the valuation date, then the value shall be the average of lowest and highest price on such date. However, if there was no trading on the valuation date, then the value shall be the average of lowest and highest price of such share or securities on the date immediately preceding the valuation date when they were the trading. Okay. Unquoted share securities. So we discussed jewelry, bullion. We discussed artistic work. Both the valuation principle are same, cost, higher of cost or FMV. Okay. Then we discuss the quoted share. Here the method of determining the FMV is that you take the average of highest and lowest price on the valuation date if there was trading, or any day preceding the valuation date if there was no trading. Right. Now we came to the unquoted share. Okay. The shares are unquoted, including the shares which are not listed. So the valuation shall be higher of the cost or the value so determined as under. So how you determine the value? By formula A plus B minus L. It will give the value of the company. Then you divide this value with the total share capital of the company and multiply the value with the shares so held by the assessee. So it will give you the value of the company in the assessee's hand. Okay. So how to come to the fair market of unquoted share? We have to understand what is A plus B minus L. We understood the PE and PV. Okay. So A is the book value of all the assets except bullion, jewelry, precious stone, artistic work, shares, securities, and immovable property. Why? Because for these assets, we know we will take the FMV, which we have just seen how to compute. So the book value of all other assets as reduced by any amount of income tax paid, if any, less the amount of income tax refund claimed, and as reduced by the amount shown as asset, including unamortized amount of deferred expenditure. It's not an asset, which does not represent the value of asset. Okay. Now you will add B. What is B? B is the fair market value of all those assets which was excluded from A. To fair market value, bullion, jewelry, precious stone, artistic work, shares, securities, and immovable property, as determined in the manner provided in this room. From the summation of A and B, A plus B, we will reduce L. What is L? L is, of course, the book value of liabilities. But liability, while reducing liability, we will not consider what? The paid up capital in respect of equity shares. The amount set apart for payment of dividend or preference shares and equity share. Reserve and surplus by whatever name called, even if the resulting figure is negative, other than those set for depreciation. Any amount representing provision of tax, other than the provision of income tax paid, if any, less the amount of income tax claim as refund, to the extent the excess over the tax payable with reference to the book profit in accordance with the law applicable thereto. The amount representing provision made for liability other than a certain liability, meaning provision made for uncertain liability. This is in the nature of reserves only. If the liability is not ascertained and you have made the provision, that's a reserve only. So reserve are not liabilities, they are the part of your profit. Any spending amount representing contingent liability other than area of dividend payment in respect of cumulative preference share. Okay. So from the liability side of the balance sheet, we will not reduce all these things. If you see, all these things are not even liability. They are the capital, all the reserves, and all the proposed dividend. Now P. P is the total amount of paid up equity share capital as shown in the balance sheet. And PV is the paid up value of such equity share for which you are doing the valuation. Understood? In respect of unquoted share security other than equity share, their value shall be higher of cost or the price that such share or security would fetch if sold in the open market or as on the valuation date. Immovable property. Their value shall be the higher of the cost or the price the property would fetch if sold in the open market as on the valuation date. Here also you can take a report from the valuer, which is registered with the recognized by the government of such foreign country. This is important. An account with a bank. So we discussed about the jewelry, artistic work, immovable property, and quoted share. Here the value, in all these cases, the value is the higher of the cost and FMV. In all cases, FMV is considered as the price which it will fetch if sold in the open market. Except in a case where, in case of listed quoted equity share, the FMV is average of highest and lowest price on the valuation date if there was a trading, or on any day preceding the valuation date if there was no trading. Right? Or in case of unquoted equity share, the value is determined based on the formula A plus B minus N. A is the book value of the asset. B is the fair market value of all these assets which we just discussed: bullion, jewelry, valuable precious stones, share, security, immovable property, right? And L is the book value of liability except the capital, proposed dividend, and the reserves. Okay. Now we have come to bank account. If there is a foreign bank account, how such bank account shall be valued? So, see, it's very important. There's a catch. It says it's not the closing balance. It says the sum of all deposit made in the account with the bank since the date of opening of the account. So we are not talking about the withdrawal. Whatever amount has been deposited, you aggregate that deposit from the date the account was opened. Shall be the fair market value of such bank account. However, where any declaration was made when this act came into force, then the sum of all deposit made in the account with the bank since the date of such declaration. Then we will see the deposit after the date of such declaration. Okay. However, where any deposit made from the proceed of any withdrawal from the account. So there's a contra. There are two accounts. From one account there is withdrawal and to the other account there is a deposit. Such deposit shall not be taken into account while computing the value of the account. So of course, contra items are ignored. Okay. If the assessee has any partnership interest, he is a partner in a foreign partnership firm, or as a LLP interest, is a partner in a LLP or in an AOP, of which the assessee is a member, that the value of such interest, how to determine? Then first to determine the value of such firm, AOP or LLP, right? In the manner I discussed above, you value the entire firm. Then whatever value so determined, the amount up to the capital shall be proportionate with the member in the ratio of the capital, and the balance amount shall be allocated to the partners in the ratio of dissolution. Dissolution ratio means if there is any dissolution ratio, that is, if it is there that on dissolution, what the partner shall receive, if there is any ratio given in the partnership deed, that the remaining amount shall be distributed in such ratio. If there is no such dissolution ratio, then the remaining amount shall be distributed in the PSR, profit sharing ratio. Okay. So first, up to the amount of aggregated capital, the amount shall be distributed in the ratio of the capital, and the balance amount shall be distributed in the ratio, dissolution ratio, and then the absence of dissolution ratio in profit sharing ratio. So see what it says. the net asset of the firm AOP or LLP on the valuation date shall first be determined. Thereafter, the portion of the net wealth of the firm, AOP or LLP as the case may be, as is equal to the amount of capital shall allocated among the partner member in the proportion in which capital has been contributed. Okay. And the residual of the net asset shall be allocated among the partner member in the following manner. So up to the amount of capital should be distributed in the ratio of capital, and the remaining amount shall be distributed in the following manner, which is in the event of dissolution of AOP or firm. The manner of allocation is in accordance with the agreement of partnership association for distribution of asset. If there is any resolution issue, in the absence of such agreement for distribution of asset dissolution, if there is no such dissolution ratio, then the computation manner of allocation shall be in the proportion in which the partner or member are entitled to share profits in the profit sharing ratio. So, understood? The sum total of the amounts allocated. Firstly, we allocate on the basis of capital, then we allocate it on the basis of dissolution or profit sharing ratio. The total of these two accounts shall be treated as the value of interest of that partner in the partnership or association of persons. Right? Net asset of the firm AOP or LLP shall be A plus B minus L as determined above. So A is book value of asset other than the jewelry, etc. B is fair market value of these assets which are excluded from A. L is the book value of liability excluding capital, dividend, and reserves. Right? Any other asset shall be valued at higher of the cost or the price it would fetch if sold in the open market as on the valuation day. Okay. If any of the asset was transferred before the valuation date, then its FMV shall be you will do the comparison between the cost and the price at which it is transferred. Earlier, we were doing the comparison between the cost and its fair market value of the valuation date. But now, if it is transferred on the valuation date, we will do the comparison between the cost and the price at which it is transferred. Higher of these two amounts shall be the value for the purpose of Black Money Act. When asset other than bank account was transferred before the valuation date, the FMV of such asset shall be higher of the cost and the sale price. Okay. So, in all the above, we discussed higher of the cost and the FMV. Or if it is transferred before the valuation date, then instead of FMV, we will take sale price. Okay. But in one circumstance, we will not take the sale price. If this sale price is not at arm's length, it's not genuine. See what it says? It says, however, where such assets were transferred without consideration or for inadequate consideration before the valuation date, then FMV shall be the higher of cost and FMV on the date of transfer. Then we will not consider the sale price. We will consider the FMV only, but such FMV shall be of the date of transfer, not of the valuation date. Clear? So it says, if any asset has been transferred before the valuation date, then the value shall be cost or sale price, whichever is higher. Right? However, if this sale price is not genuine, means the asset was transferred for inadequate or without consideration, then instead of sale price, we will take the FMV. But the FMV shall be of the date on which the asset was transferred and not of the valuation date. Clear? Hai? Okay. Now, sometimes what happens is that the assessee sells one asset and purchases another asset. Now, in such case, how the value shall be determined for Black Money Act? So it says that there will not be double counting. So if the proceed of sale of one asset, asset A, is utilized for the purchase of asset B, then while computing the fair market value of A, we will reduce the amount which it utilized for purchase of asset B. Clear? It says, if I have a asset A and I sold it for say 20 crore, out of this 20 crore, I use 10 crore to buy asset B, right? Then whatever the value is determined for A using the formula which we discuss about, say the value discussed is arrived at 20 CR, then the fair market value of A for the black money shall not be 20 CR, shall be 20 CR minus 10 CR at 10 CR. Because this 10 CR is used for purchase of B, and B is also undisclosed foreign asset. So this 10 CR is in A also, in B also. So to avoid double counting, it is reduced from A. Clear? What it says? Fair market value in a case where new asset is acquired out of consideration received on account of transfer of an old asset or withdrawal from a bank account. In such a case, the fair market value of old asset or the bank account, as the case may be, determined according with Rule 3.1 or 3.2, shall be reduced by the amount of consideration invested in the new asset. So whatever value you have determined for the old asset, such value shall be reduced by the amount you have used by the amount of the consideration invested in the new asset. Okay? There's a small example. It will make the concept very much clear. House A is located in a country outside India, was bought in 1995 for 15 lakh. It was sold in 2004, 22 lakh. Okay. So the value for the purpose of black money is higher of 15 and 22, means 22 for house A, right? This amount was deposited in bank account in that country. So when it is deposited in a bank account in that country, so while computing the fair market value of the bank account, it shall be included. So now I have to reduce it from house A. In the year 2001, another house B was purchased for 35 lakh. Okay. The investment in house B was made through withdrawal from the bank account in foreign country. So this 35 lakh was made, investment was made from the withdrawal bank account. So whatever the amount, whatever the value I determined for the bank, I will reduce such value by 35 lakh, because this 35 lakh shall be taken care as in the valuation of house B. House B has not been transferred before the valuation date, because I still hold it, and its value on the valuation date is 48 lakh. So house B is 48 lakh. Assuming that value of foreign bank account as computed under Rule 3 is 60 lakh. So out of the 60 lakh, I have used 35 lakh for purchase of house B. So this is there in the valuation of house B. So to avoid double counting, I will reduce 60 lakh by 35 lakh. So this comes to 25 lakh. The fair market value of asset will be computed in the following manner. Okay. So for house A, the fair market value is nil, 22 minus 22. You understood why nil? Because the value is 22 lakh, but this 22 lakh has been deposited in a bank account, and the value of bank account is 60 lakh. So this 22 lakh is a part of the 60 lakh also. So to avoid double counting, I have reduced it from house A. Otherwise, it would be part of house A also and bank also. So this double taxation. So to avoid this, the law says that you take it only once. How it says that? So you will reduce from the old asset. Okay. Now for bank, it is 25 lakh. Why? Because out of this 60 lakh, there is 35 lakh for which is there in house B as well. Because I have used this 35 lakh for purchase of house B. This is included in 60 lakh also. So if I have included 35 lakh in 60 lakh also as a part of valuation of bank, and in 48 lakh also as a part of valuation of house B, then double counting. To avoid it, it says that you reduce it from the old asset. Old asset is the bank. So I reduce 35 lakh from the bank, and the value for the bank comes to 25 lakh. Okay. And for house B, it is 48 lakh. It has not been transferred, so it's clearly 48 lakh. Now rate of conversion. So we convert the foreign currency into the INR. You know? However, if no direct conversion is available, you will use the conversion rate by means of USD, United States dollar. So you convert such foreign currency into USD and then USD into INR. Now, we have been talking about valuation date, valuation date, valuation date. What do you mean by valuation date? In respect of asset declared in Section 59, it is 1st July 2015 when the Act comes into place. In any other case, it is 1st April of the previous year. Clear? Now, scope of total undisclosed foreign income and asset. So, total for undisclosed foreign income and asset of any previous year would be the income from sources located outside India, which has not been disclosed in the return of income filed under Income Tax Act on or before 139(1), due date of 139(1), or in the belated return or in the revised return. So, if there is any foreign income which has not been disclosed in the income tax return, original, revised, or belated as the case may be, then such income shall be treated as undisclosed foreign income. Or if the assessee has not furnished a return of income at all, but the assessee was required to furnish in respect to such income, and the value of undisclosed foreign assets. How you determine the value? We just understood. Okay. It says the income included in the total income, in the total undisclosed foreign income and foreign assets under the Black Money Act will not form part of total income under that. If any amount is treated as undisclosed income or asset under the Black Money Act, then the provisions of Income Tax Act shall not apply on such income or asset. The reasoning is clear. You cannot tax same income or same asset under two different acts. So the provision of Black Money Act specific to tax such foreign income, undisclosed foreign income, and undisclosed foreign asset. So such provision shall apply, and the provision of Income Tax Act shall not apply. It has made very clear. Now, not only this, it says no deduction in respect of any expenditure or allowance or set off of any loss will be allowed in computing the total undisclosed foreign income and asset of the previous year of the assessee, irrespective of whether same is allowable under the Act or not. So, no deduction expenditure allowance shall be allowed against the undisclosed income and the asset under the Black Money Act. However, there is one deduction which is available, which is from the value of undisclosed income and the asset located outside India, any income which has so far been assessed to tax under the Income Tax Act prior to the assessment year to which this act applies, and any income which is assessed to tax for assessment year under this act will be reduced. If the assessee can prove that the asset so purchased outside India was from the income which has already been assessed in India under the Income Tax Act, then such an income, such an amount shall be reduced from the valuation of the foreign assets. Understood? But then, of course, it's very logical. Why? Because in respect of such amount, to the extent of such amount, such foreign asset has been excluded. Right? However, assessee has to furnish the evidence of satisfaction of the AO. The asset has been acquired from the income which has been assessed or assessable. So if assessee proves that the asset was acquired from the income which has already been assessed in India under the Income Tax Act, then to that extent it shall be deemed that the asset, the value of the asset is explained, and therefore there is no undisclosed foreign asset to that extent. So if the value of the asset comes out to be say 1 CR, and if the assessee could explain 20 CR, then only the undisclosed foreign asset for the purpose of Black Money Act shall be the 80 CR. Okay. However, if the property, so foreign property, if the foreign asset is in the form of immovable property, then how we compute it? Say, at the time of purchase of the property was purchased for say 20 CR, right? Out of this 20 CR, I explained to the black money authorities that 5 CR is from the income which has already been assessed in India under the Income Tax Act. Right. Now, on the valuation date, the value of this 20 CR becomes 50 CR. So, on the date of valuation, this asset is valued at 50 CR. Then, out of this 50 CR, the law says that 5/20 shall be deemed to be explained. So, out of this 20 CR, 5 CR is explained. So, out of this 50 CR, the proportionate amount shall be deemed to be explained. So, it comes to 12.5 CR. So, undisclosed asset shall be 50 minus 12.5, which comes to 37 points. Understood? So, this 5 CR would become 12.5 because I have invested 20 CR. Out of this 5 CR is explained. So at that time, only 15 CR was undisclosed. Now this 20 CR becomes 50 CR. So I am not concerned about 50 CR. You can only tax me 15 CR proportionate amount. So this 15 CR would become 37.5 CR. You understood how we compute it? So it says, if the deduction referred to in P above in respect of income which is assessable or has been assessed to tax is in relation to immovable property, the quantum of deduction would be the amount which bears to the value of the asset as on the first day of the financial year in which come to the notice, meaning the valuation date. The same proportion as the assessable assessed for an income bears to the total cost of the asset. So assessable assessed for an income means 5 CR in our example. Total cost was 20 CR. So 50 CR shall be in the same proportion. It has given a small example. A house property located in a country outside India was acquired by Mr. A, an SSC, in the previous year 12-13 for 60 CR, 60 lakh. So property was acquired for 60 lakh. Out of the investment of 60 lakh, 35 lakh was assessed to tax in the total income previous year 12-13 and earlier years. So the SSC have proved that I have purchased the property for 60 lakh, but out of 60 lakh, 35 lakh has already been taxed in India under the Income Tax Act. So to that extent, there is no undisclosed asset. So such undisclosed assets comes to notice of AO in 25-26. If the value of the house property in 25-26 120 lakh, then the amount chargeable to tax shall be X minus Y. X is 120 lakh and Y is 120 lakh into 35, which is explained out of 60, the price cost for which asset was purchased. So 70 lakh is already explained out of 120 lakh. So my undisclosed asset is only 50 lakh. Clear with you? Okay. So these two things, if the old asset is sold and the new asset and the proceeds invested in the new asset, then how we do the valuation? I told you, then whatever proceeds is invested in the new asset, such proceeds are reduced from the valuation of the old asset, right? And in case of immovable property, if you explain a part of the cost of the asset by the reason that such part was already offered to tax in India under the Income Tax Act, then such part proportionate to the fair market value of the asset as on the valuation date shall be excluded. Clear? Okay. Now we are talking about the penalties. The main fear which has caused in the public. Oh, so you see, there's a huge penalty. It says, in case where the tax has been computed in respect of undisclosed income, foreign income, and asset, the AO may direct the assessee to pay a penalty in addition to tax, a sum equal to 3 times of tax so computed. So 300% of the tax is the penalty. First, the tax is 30% of the undisclosed income and other asset. That penalty is 3 times of such 30%. So if you see, it would exceed the amount of the income of the asset. So if there is an income undisclosed asset of 100 CR, then there is a tax of 30 CR, and on 30 CR there is a penalty of 90 CR. So it becomes 120 CR more than the value of the asset itself. Okay, so that's a very draconian provision for Black Money Act. That is very intentional to to bring a fear in the minds of the people that they don't do a black money invested outside India. Okay, you understood? The tax and the penalty exceeds the value of the asset. Now, penalty for failure to furnish return in relation to foreign income and asset. If the assessee failed to furnish the return of income and or it furnished the return of income but did not disclose the foreign income or the asset, then there's a penalty equivalent to the 10 lakh rupees for failure to disclose. If you have some asset outside India, if you fail to disclose, then the penalty is 10 lakh rupees for each year. See the amount of the penalty, right? So 42 says if you fail to furnish the return, 43 says you furnish the return, but you have not disclosed the foreign income or the asset. However, this 10 lakh penalty shall not be levied when if there is an asset other than immovable property and the value, aggregate value of such asset does not exceed 20 lakh. If you have not disclosed the foreign asset in your return of income, filed under section 139, or you have not filed the return of income in respect of foreign asset, then the penalty of 10 lakh shall not be levied if such foreign asset is not in the form of immovable property and the aggregate value of all such asset is up to 20 lakh. So there is a benefit given to small assessees if the value of the foreign asset, which they have not disclosed in the return of income, if such value is up to 20 lakh and the asset does not include immovable property, then the penalty of 10 lakh shall not be levied. Clear? Now there is penalty for other default ranging from 50,000 to 2 lakh. And what are the defaults? If the assessee failed to answer any question put to him by tax authority, or failed to sign any statement made by him in the course of proceeding under this act, or failed to attend or produce books of account or document at the place or time if he is required to attend or to give evidence or produce books of account or other documents at certain place and time in response to summon issued under section 8. However, similar to income tax, prior approval of JC or joint actor is required if the penalty exceeds 1 lakh and tax officer levying the penalty is in the rank of ITO, or if the penalty exceeds 5 lakh and the tax officer levying the penalty is in the rank of assistant commissioner or deputy commissioner or assistant director or deputy director. So the administration of Black Money Act is also done by the income tax department only. Prior approval is required if penalty is being levied by the ITO and the penalty amount exceeds 1 lakh. If the penalty is levied by the ACIT or DCIT and the penalty amount exceeds 5 lakh. Now, let's talk about the prosecution under the Black Money Act. Okay. Firstly, it says these prosecutions are in addition to any other penalty levied under the Act in respect to the same default. If the default is, if the assessee failed to furnish return in relation to foreign income and asset, then there can be prosecution with rigorous imprisonment for a term which is not less than 6 months, but which may extend to 7 years and with fine. However, prosecution will not be attractive if such return is furnished before the expiry of the assessment year. In case the assessee failed to furnish information about an asset located outside India in the return of income. Earlier, the assessee has not furnished a return of income. Now, if it has furnished a return of income but it had not disclosed the foreign asset, then the prosecution shall be rigorous imprisonment for a term which not less than 6 months, but which may extend to 7 years and with fine, same as above. Punishment for willful attempt to evade tax then the prosecution shall be rigorous imprisonment for a term not less than 3 years, but extended to 10 years with fine. What we mean by willful attempt to evade tax, penalty, or interest. So if any person has in his possession or control any books of account or other document containing a false entry, or make or cause to make any false entry or statement in such books of account, or willfully omit or cause to be omitted any relevant entry or statement in such books of account, or cause or other circumstances to exist which will have the effect of enabling such person to evade any tax, interest, or penalty chargeable or imposable under this act. Punishment for false statement in verification. Then in such case, the person shall be liable for rigorous imprisonment for a term not less than 6 months or extended to 7 years and with fine. Punishment for abatement. In such case, it will be rigorous imprisonment for a term not less than 6 months but extended to 7 years with fine. Okay, so these all were prosecution provisions. Now, similar to income tax, there is also a presumption to a culpable mental state. So, as we discussed in the income tax, the court shall presume the existence of mens rea. Mens rea means culpable mental state, mean the default is committed intentionally. Okay, and the assessee has to prove a fact that there was no such mens rea, no such culpable mental state. Okay, it says in any proceeding for any offense under this act, which requires a culpable mental state on the part of accused, the court shall presume the existence of such mental state. However, it shall be a defense for the accused to prove the fact that he had no such culpable mental state. Right? As we discussed, culpable mental state means the intention, motive, and knowledge of a fact. So the default is done with the knowledge of a fact. Okay. And most important, similar to income tax, a fact, the assessee is said to prove the fact only when the court believes it to exist beyond reasonable doubt and not merely with the existence of preponderance of probability. So the assessee has to prove the non-existence of mens rea without reasonable doubt. Okay. Similar to income tax, the prosecution has to be initiated with the instance of principal chief commissioner, principal director general, or principal commissioner or commissioner, as the case may be. There is a big act has to be done with the approval of senior officer. Similar to income tax, if the offense is committed by the company, then the person who was in charge at the time when the offense was committed shall also be deemed to be guilty of the offense along with the company. Okay. However, if such person proves that the offense was committed without his knowledge and that he had exercised all due diligence to prevent the commission of such offense, he will not be deemed guilty. So he can prove in his defense. In case of company, the director, manager, secretary, officer of a company is deemed to be guilty of the offense committed with their consent or convenience. Fine and imprisonment. If there is any imprisonment for such default, then this officer shall also be liable for the imprisonment. When offense under this act has been committed by a person being a company, okay, being an artificial entity, and the punishment for such offense is imprisonment and fine, then company shall be punished with fine. Further, every person referred above, being director, manager, secretary, or other officer of the company, will be proceeded against and punished in accordance with the provision of this act. Okay, so you cannot imprison the company, and for this you will do the same on director, manager, officer of the company. Here the term company includes a firm, AOP, BOI, or HUS. And when the company means the firm, AOP, BOI, then the reference to director means in case of firm is a partner of the firm. In case of AOP, it's a member of AOP. In case of HUF, it's a Karta and a member of the HUF. In case of company, a whole-time director. And if a company does not have a whole-time director, then any other director, manager, officer who is in charge of the affairs of the company. In case of any subsequent or second defaults, then there will be a rigorous imprisonment for a term 3 to 10 years with a fine ranging from 5 lakh to 1 CR. So you're looking what a huge amount of penalty and prosecutions. So this completes our chapter of penalty and the Black Money Act. Right. Now we'll move to our next chapter, tax audit. It's a very small chapter and the interesting one. What it says that the chartered accountant, while doing the tax audit, has to exercise the due diligence which are to be exercised as prescribed under the relevant standards of auditing. Okay. So firstly, we'll see what types of audit reports or certificates are issued under the Act. So the most important is the tax audit report under Section 44AB. Okay. Now, in addition to that, in case of Section 12AB, Form 10B and 10BB is submitted. If the assessee is claiming a deduction under Section 80IA to 80IE, then for claiming the deduction, it is mandatory for the assessee to furnish a report from chartered accountant in Form 10CCB, which says that the conditions prescribed under such section are complied with by the assessee. Okay. If the assessee is claiming deduction under Section 80JJA, then a report of chartered accountant Form 10DA is required, similar to certify that the condition of Section 80JJAA has been complied with. If provision of MAT under Section 115JB is applicable, then a report under Section in Form 29B is required, which certifies the computation of book profit. And similarly, in case of AMT under Section 115JC, a report under Section in Form 29C is required to certify the computation of book profit. In case of slump sale under Section 50B, the report is required in Form 3CEA from a chartered accountant, specifying the correctly computing the net worth of the undertaking or division. Then this Form 15CB, which the CA issues in respect of remittance outside India. See, government, including the courts, have placed immense confidence in the report of chartered accountants. So there was a case in which the books of account were destroyed by a fire. Okay. So the assessee claimed the deduction of expenditure on the basis of a audit report issued by chartered accountant. Such expenditure was challenged by the AO for non-submission of the invoices, which has been destroyed. But ITAT, relying on the report of CA, gives the benefit that CA must have reviewed the invoices, and only on basis of such review, it has allowed the expenses. And such judgment of ITAT was confirmed by even the Delhi High Court. The Delhi High Court in case of J Engineering Works Limited held as under, where the original account books of the assessee had been destroyed in a fire. It was held that appellate tribunal in allowing a deduction could rely upon other material, mainly consisting of the auditor's report, from which it could be inferred that a deduction were properly supported by the relevant entries in the accounts book. So they have placed a great level of confidence in the audit report issued by the chartered accountants. This clearly demonstrates the faith which the government and the revenue authorities have in the competency and integrity of chartered accountant due to which various statutory duties and responsibility has been cast upon them under the provisions of the Act. It is in this context that the conduct of chartered accountant has to be appreciated. So the conduct of chartered accountant has to be in line with the faith posed by the government and the revenue authorities on the report issued by them. So their reports on the competency and their integrity. Chartered accountants cannot be obvious to their professional duties and sign audit report certificate in a mechanical manner. Okay. Now, our CA Act says that CA, a chartered accountant, would be deemed to be guilty of professional misconduct. It says a chartered accountant practice would be deemed to be a guilty of professional misconduct under clause 7 of part 1 of second schedule. So he will be deemed to be guilty of professional misconduct under clause 7 of part 1 of second schedule to the CA Act if it does not exercise due diligence. If it is proved that the CA has signed a report without exercising due diligence, then he will be deemed to be a guilty of professional misconduct under clause 7. Okay? Or is grossly negligent in the conduct of his professional duty. Okay? There is another clause 8, which apply, which also says that a CA shall be deemed to be a guilty of professional misconduct if a CA, if he fails to obtain sufficient information which is necessary for the expression of opinion or its exception are sufficiently material to negate the expression of opinion. So, clause 7 is applicable if the CA has not exercised due diligence, and clause 8 is applicable if he has not obtained the sufficient evidence to support the expression of opinion. Okay? Only these two clauses are relevant for my text paper. So now, also we have studied in the first part, there's a provision section 271J, which says there's a penalty equivalent to the amount of 10,000 if there's any incorrect information in the report furnished by an accountant. If in case of an accountant furnishing incorrect information, any report furnished under the provision of this Act, then the accountant shall be liable for penalty equivalent to the amount of 10,000 for each such report or certificate. Okay. More than the monetary amount is more about the goodwill. Okay. Now we'll discuss about tax audit in section 44AB. So when tax audit is applicable in case of 44AB? Firstly, if the total sales exceed of the business or gross exceed in the business exceed rupees 1 CR in any previous year. However, this 1 CR shall be read as 10 CR if the cash receipts is up to 5% of total receipts and cash payments is up to 5% of the total payment. It says, so first requirement is if the receipts in the business exceed 1 CR. However, tax audit is not required in case such person carrying on business whose total sales in the business is up to 10 CR if the aggregate cash receipt, including amount received from sales, etc., is up to 5% of total receipts and aggregate cash payment is up to 5% of such payments. So both the conditions have to be fulfilled. The cash receipt should also be less than up to 5% and the cash payment should also be less than up to 5%. It says payment received by a check or bank draft, which is not account pay, will be deemed to be in cash. Okay. So twin condition of paragraph with respect to cash receipt and payment is to be satisfied together. So both has to be satisfied. Further, the sales is more than 10 CR, then there is a tax audit, no question, even if everything is through banking channel. Okay. However, so this was about the business. Now, if the assessee is engaged in the profession, then the tax audit required if the receipts in the profession exceed 50 lakh rupees. However, if assessee is opting for presumptive 44AE, 44BB, or 44BBB, then tax audit shall not be required and shall be required only when the assessee shows a lower income than the presumptive income as specified under such sections. Then tax audit required if assessee claims that the PGBP are lower than the profit computed on presumptive basis. In case of 44 ADA, the tax audit is required if assessee shows the income below the presumptive income under section 44 ADA and its total income exceeds the basic assumption limit. In case of 44 AD, the audit is required if assessee is covered by section 4484, which says that if earlier you were using 40, you were claiming 44 AD, but now if you are opting out of 44 AD and your total income exceeds the basic exemption limit, then you are covered by 4484. That for this year and 5 subsequent year, you are required to get your accounts audited. It says 44AB. Tax audit is not required if the assessee is opting for 44AD or 44ADA. Okay. The audit report is furnished in form 3CA or 3CB. Both the forms are accompanied by form 3CD. So either the assessee furnished form 3CA plus 3CD or it furnished CB, 3CB and 3CD. So 3CD is common, it will be furnished in all cases, but for some assessee it is 3CA or from other it is 3CB. So who is required to go for 3CA? If the person is required to get his books of account audited under any other law, then he is required to furnish the audit report from 3CA. If he is not required to get books of account audited under any other law, then he is required to furnish the audit report from 3CD. But in both the cases, the audit report is supplemented by form 3CD. Okay. Now the question comes, the requirement of audit is primarily dependent upon the turnover. The turnover exceeds 1 crore, 10 crore, as the case may be, or 50 lakh in case of profession, whatever. Then the audit requirement is there. So what is the meaning of gross received turnover as referred to in section 4480? So a guidance note gives a guidance on this. It says that a few typical cases may be considered. It says discount allowed in the sales invoice will reduce the sale price and therefore the same shall not be considered as turnover and same shall be deducted from turnover. If the discount is given from in the invoice itself, then it shall not be considered as a part of turnover and only the reduced amount of the invoice shall only be considered as a part of turnover. Cash discount, otherwise than that allowed in a cash memo or sales invoice, is in the nature of financing arrangement and therefore is generally not reduced from the turnover. Turnover discount is normally allowed to customer if the sale made to him exceed a prescribed limit particular quantity. This being dependent on the turnover is to be reduced while computing turnover. Even if the same is allowed, not as part of from the sales invoice. Special rebate allowed to a customer can be directed if it is related to a turnover, if it is in nature of trade discount. However, if it is in nature of commission, the same cannot be deducted. Price of the goods returned shall be deducted from the figure of turnover even if the sales on this return was accounted for in the preceding year. Okay. Sale proceeds of fixed asset would not form part of turnover, of course, since these are not held for resale. Sale proceed of similar to this, sale proceed of property held as investment is not part of turnover. Similarly, sale proceed of share securities held as investment is not form part of turnover. However, if they are form part of stock in trade, then of course their sale proceed form parts of turnover. Now the guidance note says broadly, the following item of receipts will be covered by the term gross receipts. Cash assistance received by any person against export from under any scheme of the government. Okay. So necessarily these all are the income under section 28. The cash assistance against export is a taxable under PGBP. Any indirect tax repaid or repayable as drawback to any person against export. The aggregate of Gross income by way of interest received by moneylender, commission, brokerage service, or other incidental charges received in the business of chit fund. So, depending upon the nature of business, these are the receipts for such businesses. Reimbursement of expenses incurred, and the same is paid to separate account in the books. Then only a net surplus shall be considered as part of turnover. Net exchange rate difference on export sale during the year on the basis of principle explained above will have to be added. Higher charges of cold storage, so these are the income from them. Liquid damages, insurance claim except for fixed assets. So insurance claim for stock in trade is part of your turnover. Sale proceeds of scrap, waste, etc., unless it is part of sale sale or turnover, whether or not credit in miscellaneous income account. Gross receipt includes lease rent in the business of operating lease. Finance income to reimburse and reward the lessor for his investment and services. Higher charge and installment received in the course of hire purchase. Advance received forfeited from customers also treated as turnover. So if any amount is forfeited from customer, such amount shall form part of turnover. The value of any benefit requisite, whether or not converted into money, arising from the business or exercise of profession. So 28.4 is also form part of turnover. Okay. Now, if the assessee is more than one business, then this limit shall be considered by aggregating the turnover of all business. This limit is assessee wise, not the business wise. Okay. So where the assessee carries on more than one business, the result of all business activities should be clubbed together. However, where assessee opts for presumptive taxation in respect of some of the business, the turnover of such businesses shall not be considered for 44AB. Where the business is covered by section 44B, BBA, turnover of such business shall be excluded. Similarly, where the business or profession is covered by section 44AD, ADA, AE, BB or triple B, and assessee opt for presumptive, then turnover thereof shall be excluded. Clear? This we have discussed from 3C and 3CB. Now revision, important part. How can the tax audit report be revised? Answer is yes. It can be revised up to the end of assessment year. It can be revised. Why? Because it may happen that after the issue of tax audit report, the assessee may have made some payment towards TDS or towards an expenditure referred to section 43B, and therefore the revision is necessary on account of claiming of deduction under section 40A, 40 or 43B. Okay. But such revision has to be made by the end or annual assessment year. The revision shall be made by the same tax auditor who had issued the earlier report, and he will apply the new UDIN on such revised tax audit report, and he shall refer this point that this has been revised tax audit report on account of what reasons. Okay. Now, while filing Form 3CD, if there's any duplicacy in the points, in the information sought, then you can submit information in the one point, and whenever the next point comes asking for the same information, you can refer your earlier response. Okay. Where there's a difference in the opinion in the tax auditor and the assessee in respect of any point, then the tax auditor should state both the points of his also and the assessee also, and the tax officer shall take the opinion. Okay. Even if the tax audit form is not updated, still he will follow the law as applicable. Okay. Now there are 44 clauses of 3CD, and a general thing is stated that how to fill this form. What all are to be filled in respect of each point. So in case of name, you must give the name of the assessee. If there is any change in the name, you must state that there is a change. In case of address and all this, These are 44 points, which are not much relevant from exam point of view, but just for your reading that what all is required to be generally disclosed in these 44 points. Okay. We call 44 clauses of tax audit report. All the 44 these clauses has to be submitted by the tax auditor and certified. Okay. Now, what the question may ask? Question may generally ask about the case study. So it may give you a case study and say you have to comment whether the tax auditor is a guilty of clause 7 or clause 8 or not. Okay. So let's see one or two case studies which may be asked similar to that in your exam. See, all these are only the relevant clauses of tax audit report. So this form 3CT is required to be submitted whether you have already been subjected to audit or not. Now we will see that, okay, we have already seen this 271B. If tax audit report is not furnished, then the penalty of 0.5% of the turnover, 1,50,000, whichever is less. So the maximum penalty is 1,50,000, right? Now case studies. So case study 1. What are the facts? It says, a survey was conducted on the premises of a hospital, consequent to which it was found that the hospital had made payment of consultancy charges to doctors. During the survey, it was found that hospital has made payment to the doctors towards consultancy, and it has not deducted tax under section 194J on such payments, even though the payment exceeded the threshold of 30,000, 50,000 as the case may be. In the tax audit report, the amount inadmissible under section 40A IA for non-deduction of TDS was mentioned as nil. Also, there was no mention of or reporting of TDS section 194J in clause 34. Okay. Neither the tax auditor said that any tax has been deducted in section 194J, nor it qualified the report by showing a disallowance under section 40A IA. So, what was the contention of the chartered accountant? So, the chartered accountant contended that since the doctors did not provide any professional service to the hospital, the provision of section 194J will not be applicable. He again explained that due to unavoidable reason, the hospital collected the consultation fee on behalf of doctor, and same is paid or remitted to the doctors. And therefore, there is no expenditure booked in respect of this in the hands of hospital, and therefore, question of TDS does not arise. He also contended that as per the decision of tribunal in the case of Mullin shipping, section 40 IA disallowance arises only in case of amount payable as at the end of the financial year and cannot apply in respect of payment made during the financial year. Okay. Therefore, according to him, the payment made to doctor by way of reimbursement of fees collected from patient does not fall under stamp of TDS, and even if it does, the same is not disallowable under section 40 AIA because of that judgment due to above decision. Okay. For knowledge, it is stated that the Supreme Court has overruled such decision, and also there is a CBD circular which overrules such decision. Now, how will you conclude? So it says that what are the contention of chartered accountant? That the hospital has not claimed expenditure, which is factually incorrect because consultancy expenditure is being shown in its profit and loss account. Secondly, whatever judgment he is referring to, he is relying on, was not mentioned in the tax audit report. He ought to have mentioned the tax audit report. So the chartered accountant is a guilty of professional misconduct under clause 7 for not exercising due diligence in issuing a report. So what the basic conclusion is? As per the guidance note, tax auditor is required to report as to whether tax is deductible and any amount is admissible, respectively. If tax has not been deducted on the basis of a court judgment in a particular case, then tax auditor is required to disclose the same in his report so as to enable the income tax department to know the reason as to why tax has not been deducted. But in this case, the CA has not done so. On a perusal of the P&L account of the hospital, it has been noted that consultancy charges were shown as expenses in the P&L account. Thus, the contention that the hospital collected the fee on behalf of doctor and payment such fee is not an expenditure is not correct, since such expense has been debited to P&L account. So in this case, the CA has ignored the reporting requirement and had not exercised the due diligence in carrying out his professional duty. Hence, he was held to be guilty of professional misconduct, falling within the meaning of Clause 7 of Part 1 of Second Schedule of the CA Act, 1949. Clear? Okay. Case study 2. Let's do this case study more. Last case study. A search was conducted under Section 132 of the Income Tax Act in the case of PQR Jeweler. Okay. And 30th Jan 2026. As part of post-search inquiries, data from billing software was analyzed. On analysis of this data, it was found that the concern was involved in violation of Section 40A3, cash payments, in a major way to the tune of 30 crore in the purchase of old gold. So during the search, it was found that the assessee has made a payment for purchase of old gold to the extent of 30 crore in contravention of provision section 40A3. Okay. The tax audit report of the concern was issued by a chartered accountant section 44AB. The audit report has a specific clause, namely 21D, concerning compliance of section 40A3. How the chartered accountant has not properly filled up this clause and had failed to highlight the extensive violation of 40A3. Okay. So now let's see. So in the search, it was found that there is an extensive violation of 40A3, cash payments, but CA has not disclosed such violation in the tax audit report. Now, what is the contention of the CA? The CA submitted that he had done cash check and he did not come across any payment which warrant disclosure in Form 33 CD. So he said that I did the test check and I could not find any cash payment. He also submitted the standing instruction given by management of the entity to the employees to make payment above 10,000 only through account pay check and a bank draft for the permissible accounting mode. Copy of these instructions were verified by him. He also taken a representation from the management that net payment in cash to any person in a day did not exceed 10,000, means it was within the limit of 40A3. Therefore, tax auditor submit that he had taken reasonable professional care and on the basis of tax check, nothing came to the attention to warrant a reporting of violation. But you understand the violation is not small. It's extensively 30 CR. Now let's see what the department has to say. The investigation department said that as part of post-search inquiry, data from billing software analyzed and 40A3 violation was seen to the tune of 30 crore. And the department has also approached the customers, and customers admitted on oath that they have sold the old gold to the assessee for amount in cash. It says the tax auditor has mentioned a yes in response to statement in clause A of clause 21D on whether expenditure covered under 48.3 were made by account pay check. So he has not qualified the report, rather he has sent the yes. Then the department said that as per the guidance note, the auditor should have obtained a list of all cash payment made in excess of 10,000 rupees made by assessee during the previous year. The list should have been verified by the tax auditor with the books of account, and details of payment which do not satisfy the above condition should have been reported in the tax audit report. And finally, it says that in the given case, given the massive scale of violation, the chartered accountant has not exercised reasonable due diligence. So, in the conclusion, what is the answer? There is a specific disclosure for 48.3 in the tax audit report. The contention of the charter on the tax checks conducted by him did not reveal any of the aforesaid violation is not tenable. Considering the nature of the business of the assessee, namely jewelry business, the onus was on the charter account to verify the same before reporting in Form 3CD. Stating the fact that no such transaction was identified during the tax check is not acceptable because such payment can be identified independent of bank transaction. However, the charter accountant has extended the verification to cover the same. Mere reliance on certificate issued by management is not accepted. So had the chartered accountant reconciled the expenses with the bank statement, he would have come to know because the amount of cash payment is excessive. So it was held that chartered accountant was required to point out in the tax audit report the violation of provision section 1048(3). However, the chartered accountant certified there was no such instance, though the such instance aggregate to large quantum of 30 crore. Thus, the chartered accountant was held to guilty of professional misconduct with the meaning of clause 7 and 8 of part 1 second schedule of the CAI. Understood? So this all was about the tax audit report. By this, we have completed the 2 chapter today, and we conclude our class on this note. And tomorrow we'll discuss another chapter, non-resident taxation. Okay? So thank you for your time. Thank you. Yes, sir. Good luck.